Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Stephen Mulholland and Mark Kuperstock. They're both principals and founding partners of Mulholland and Kuperstock Asset Management, and they're here to discuss taking risk when the expected return justifies it. It is great to have you both with us. And Stephen, I'm going to start with you. Give us a summary of the strategy.
Perfect. Thanks for having us, Jill. And that's a great intro and setup. So this ETF is very different than the other funds in the marketplace. It's a unique strategy. We start with risk. Warren Buffett had a line. There are two rules for investing. Rule number one, don't lose money. Rule number two, don't forget rule number one. So from 1999 through last week, the S&P did 6% a year annualized returns with a standard deviation of 20%, or a ratio of about 1 to 3. Our fund's very different. We target a ratio of greater than equal to 1. So as you perfectly said, we start with risk and then we go with return. My compliance officer's here, so I can't tell you what our model results generated, but I think our clients will be quite happy. And we use a combination of trend and valuation to identify the risk in the market before we take any. Today, the fund is half in U.S. Treasury bills and half in an S&P 500 low-cost index fund.
So great question for a compliance officer. What type of investor is this product suited for?
Yeah, it's really suited for anybody who depends on their investment portfolio to live on. If they need to take drawdowns every year, it's great for pension plans. It's great for nonprofits. It's really good for anybody who's looking to capture the upside of the market, but minimize the risk on the downside.
And Stephen, what differentiates this ETF from other ETFs and mutual funds that are available today?
The closest competitor is a mutual fund with about $6 billion in assets under management. What makes us different is they always buy insurance on their portfolio, sort of like a homeowner always having fire insurance. The trouble with that is it can be very expensive, especially when the markets are volatile. We only buy insurance when we judge ex ante the risk to be high. So again, the results will be in the ETF. But because we only hedge opportunistically rather than every day, the cost will be much lower. Therefore, the returns should be significantly better. So we're comfortable when our product comes out in the advisor community. This product's very popular with financial advisors because the demand is there. Who wouldn't want to generate the same returns as the stock market with substantially shallower drawdowns? But the way we achieve those results is totally different. There's also some tail risk funds, but they run into the same problem. Everybody rushes to buy tail risk in September 2001, the fall of 1999, 2007. So academic literature and the results of these funds show while you can minimize risk, it's so costly that the results are poor. So what separates us is the same objective, but the internal algorithm we use that only buys the insurance when the risk return is favorable, when the cost is low.
What was the genesis behind this strategy?
Great question. My mom and my dad. My mom's a retired college professor with a wonderful house in Laguna Beach. I want to keep her retired. My dad was a student of the legendary Ed Thorpe, who first proved in a supercomputer you could count cards in blackjack. A great guy. He wanted to make sure individuals who knew the strategy would be able to beat the casino, so he wrote a book about it. I grew up hearing stories, talking with my dad. And there's one puzzle in particular that every CFA charter holder, people at the big investment banks know. We can predict the market over a decade, but we can't do it that well over 1 or 2 or 3 years. Why? A part of the answer to that puzzle is in the ETF.
Oh, interesting. All right, Mark, what else should the audience know?
It's really simple. It's for anybody really looking to capture the market, the equity on the upside, and minimize the downside. There's no smoke and mirrors. It's our proprietary algorithm, and we're excited about obtaining that objective.
All right, Mark, Stephen, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.